You know what's interesting? While everyone's been watching gold hit record highs, something far more significant has been happening behind the scenes. And if you own physical gold right now, you need to understand what's coming because it's going to change everything about how this market operates. Let me paint you a picture of what's actually happening right now. Central banks around the world just bought over 400 tons of gold in the first half of this year. Now you might think that's normal, but here's what makes it extraordinary. They did this while gold was trading at all-time highs. Think about that for a second. These are the most sophisticated financial institutions on the planet, and they're buying aggressively at prices that would make most retail investors hesitate. Why would they do that? What do they know that the average person doesn't? The answer lies in understanding a fundamental shift that's taking place in the global monetary system. And it's not just about price. It's about something much more profound. It's about the very nature of what gold represents and how it functions in our financial system. Let me take you back to a moment in history that most people have forgotten. August 15th, 1971. President Nixon closes the gold window. The dollar is no longer convertible to gold. At that moment, the entire global monetary system fundamentally changed. Gold went from being money to being just another commodity, or at least that's what they wanted you to believe. But here's what actually happened. In the years following that decision, gold went from $35 an ounce to over $800 by 1980. That's not a commodity move. That's a monetary event. People around the world were voting with their wallets, saying they didn't trust this new system of pure fiat currency. Fast forward to today, and we're witnessing something remarkably similar, but on a much larger scale. The difference is, this time it's not just individuals making this decision, it's entire nations. China has been consistently adding to its gold reserves. Russia rebuilt its reserves after sanctions taught them a harsh lesson about holding dollar-denominated assets. India, Turkey, Poland, Singapore, the list goes on. These aren't random purchases. This is a coordinated move away from dollar dependency. But here's where it gets really interesting. The way these central banks are buying gold tells you everything you need to know about what they expect to happen next. They're not buying paper gold. They're not buying ETFs or futures contracts. They're demanding physical delivery, bars and vaults, real metal they can touch. Why does that matter? Because there's a massive difference between owning a piece of paper that says you own gold and actually having the physical metal in your possession. And that difference is about to become very, very apparent. Let me explain how the gold market actually works, because most people don't understand this. When you see the gold price quoted on financial news, that price is being set in two main places, the COMEX in New York and the LBMA in London. These are paper markets. For every ounce of physical gold that exists in their vaults, there are multiple claims on that same ounce. It's like a game of musical chairs, except instead of chairs, it's gold bars. And the music is still playing, so nobody's worried yet. But what happens when the music stops? What happens when everyone who holds a paper claim decides they want physical delivery at the same time? We've already seen glimpses of this. During the early days of the pandemic, something unprecedented happened. The price of gold in New York traded at a significant premium to the price in London. This should never happen. Gold is gold, right? An ounce in New York should be worth the same as an ounce in London. But it wasn't. And the reason was simple. There was a shortage of physical gold in the right place at the right time. The paper market was saying one thing, but the physical market was saying something completely different. It was a warning shot that most people missed. Now, here's what's happening right now that should concern anyone who owns physical gold, or anyone thinking about buying it. The gap between the paper market and the physical market is starting to widen again, but this time, it's not because of a temporary logistics problem. It's because of a fundamental shift in demand. Think about what central banks are doing. They're taking physical gold out of the market and locking it away in their vaults. That gold isn't coming back into circulation. It's being removed from the available supply permanently. At the same time, individual investors around the world are doing the same thing. They're buying physical gold and holding it. This creates a problem for the paper market. Because remember, the paper market operates on the assumption that most people won't actually want physical delivery. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their money at once. We're approaching that moment. And when it arrives, one of two things will happen. Either the paper price will have to rise dramatically to reflect the true scarcity of physical metal, or the paper market will break entirely, and we'll see a complete separation between paper gold prices and physical gold prices. Now, if you're sitting on retirement savings right now, this is where things get personal, because the implications of this shift extend far beyond just the gold market. This is about the stability of the entire financial system. Let me tell you about something that most financial advisors won't mention. There's a way to hold physical gold inside your retirement account. It's called a gold IRA. And the reason I'm bringing this up is because if this separation between paper and physical happens, having actual metal in your possession, even if it's in a retirement account, could make an enormous difference. I've put together a free guide that explains exactly how this works, how to do it without tax penalties, and what to look for. It's in the description below. If you've got $100,000 or more in retirement savings, it's worth understanding your options here. But let's get back to what's driving all of this, because understanding the why is crucial to understanding what comes next. The global monetary system is under stress in ways that most people don't see. The dollar's role as the world's reserve currency is being challenged, not by another currency, but by a return to the oldest form of money humanity has ever known: gold. Countries are tired of having their foreign reserves frozen or sanctioned. They're tired of watching the value of their dollar holdings erode through inflation. They're tired of being dependent on a system where one country controls the printing press for the world's reserve currency. So they're diversifying, and gold is the obvious choice because it's the one asset that isn't someone else's liability. When you hold gold, you're not dependent on any government's promise to pay. You're not exposed to any central bank's monetary policy. You're holding something with intrinsic value that has been recognized for thousands of years. This is why the buying continues even at record prices, because from the perspective of these central banks, they're not buying gold. They're buying insurance. They're buying independence. They're buying optionality for whatever comes next. And what comes next is where things get really interesting, because we're not just talking about a gradual shift here. We're talking about a potential phase transition in how the global monetary system operates. Let me give you a historical parallel. In the 1960s, there was something called the London Gold Pool. It was an agreement between central banks to keep the gold price suppressed at $35 an ounce by selling gold into the market whenever the price started to rise. For years it worked, until suddenly it didn't. The demand for physical gold became so overwhelming that the pool collapsed, and when it did, the price of gold exploded. That was the beginning of the end for the Bretton Woods system. Within a few years, Nixon had no choice but to close the gold window entirely. We might be approaching a similar moment right now. The difference is, this time there's no gold pool. There's no coordinated effort to suppress the price. Instead, we have the opposite, a coordinated effort to accumulate as much physical gold as possible. The paper market has been the mechanism for price discovery for decades. But what happens when the physical market becomes so tight that the paper market loses credibility? What happens when the people who hold paper contracts realize that they might not be able to convert them to physical metal? This is not a theoretical question. This is a practical concern that's keeping people in the gold market awake at night. Because if there's a run on physical gold, if everyone who holds a paper claim suddenly wants delivery, the system simply cannot handle it. There isn't enough physical gold to satisfy all the paper claims. And here's the thing that makes this situation so precarious. It doesn't require everyone to demand delivery. It only requires enough people to demand delivery that the system can't meet the demand. Once that happens, confidence evaporates. And in a confidence-based system, once confidence is gone, it's almost impossible to get back. We've seen this pattern play out in other markets. We saw it in the housing market in 2008. Everyone thought housing prices would keep going up forever, until suddenly they didn't. The system was built on the assumption that not everyone would default at once. But when enough people defaulted, the entire structure collapsed. The gold market has a similar vulnerability. It's built on the assumption that not everyone will want physical delivery at once. But what happens when that assumption is tested? Now, let me show you some numbers that illustrate just how precarious this situation is. The COMEX, which is the primary futures exchange for gold in the United States, has a certain amount of gold in its registered vaults. This is gold that's available for delivery against futures contracts. At any given time, the amount of open interest in gold futures, meaning the number of contracts that could potentially demand delivery, is many times larger than the amount of physical gold available. This isn't a secret. This is how the market is designed to operate. It's a fractional reserve system, but the ratio has been growing. The amount of paper claims relative to physical gold has been increasing, and at some point, that ratio becomes unsustainable. We're also seeing something interesting in the retail market. Premiums on physical gold coins and bars have been elevated for months. When you go to buy physical gold from a dealer, you're paying significantly more than the spot price you see quoted on financial news. That premium represents the real supply and demand situation in the physical market. If gold was truly abundant, if there was plenty of physical supply to meet demand, those premiums would be minimal. But they're not. They're elevated and staying elevated. That's telling you something important about the actual availability of physical metal. Meanwhile, gold ETFs, which are supposed to be backed by physical gold, have been seeing outflows in some periods even as the price rises. This is unusual. Typically, when the price of an asset is rising, you see inflows into ETFs as investors want exposure. But some investors are pulling money out of ETFs and buying physical instead. Why? Because they're worried about counterparty risk. They're worried that in a crisis, the ETF might not actually have all the gold it claims to have, or they're worried that even if it does, they might not be able to get their hands on it when they need it. This is the kind of behavior you see when people are losing confidence in the system. And once that process starts, it tends to accelerate. Let me tell you about what happened in 2011. Gold hit an all-time high of around $1,900 an ounce. Everyone thought it was going to keep going up, but then it didn't. It entered a bear market that lasted for several years. The price eventually bottomed around $1,050 in late 2015. What happened? Why did gold fall when all the fundamentals seemed to support higher prices? The answer is that the paper market overwhelmed the physical market. Massive selling in the futures market drove the price down, even though physical demand remained strong. Central banks kept buying. Individual investors in Asia kept buying. But the paper market set the price, and the paper market said gold was going down. That experience taught a lot of people a valuable lesson. The paper market can diverge from the physical market for extended periods. But here's the thing. It can't diverge forever. Eventually, reality reasserts itself. Eventually, the physical market wins. And we might be approaching that moment now. Because this time the physical demand isn't just strong, it's overwhelming. And it's coming from the most powerful players in the market, sovereign nations. When a central bank buys gold, that gold is gone. It's not coming back into the market. It's not available for lease. It's not available for sale. It's locked away as a strategic reserve. And when enough gold gets locked away like this, the available supply for everyone else shrinks dramatically. This is creating a squeeze. Not the kind of squeeze you see in meme stocks where retail traders coordinate to drive up the price. This is a fundamental supply squeeze driven by the largest, most sophisticated buyers in the world, systematically removing supply from the market. And here's what makes this squeeze different from anything we've seen before. It's happening at a time when mine production is struggling to grow. Gold is getting harder and harder to find. The easy deposits have been mined. New discoveries are rare. And even when new deposits are found, it takes years, sometimes decades, to bring a new mine into production. So you have surging demand from central banks, steady demand from jewelry and industrial users, growing demand from individual investors, and supply that can't keep up. In any other market, this would lead to an obvious outcome: sharply higher prices. But in the gold market, the paper market has been able to moderate that price increase by creating unlimited paper supply. You can't create more physical gold, but you can create more gold futures contracts. You can create more unallocated gold accounts. You can create more paper claims on gold. And as long as people are willing to accept paper instead of physical, that works to keep the price in check. But what happens when people stop accepting paper? What happens when the demand for physical becomes so intense that the paper market loses its ability to set the price? We're starting to see the early signs of this. The premium for physical gold over paper gold is widening in certain markets. The time it takes to get delivery of physical gold is lengthening. Dealers are running low on inventory. These are all symptoms of a market that's getting tight. And if you understand market dynamics, you know what happens in a tight market when demand surges. The price doesn't just go up gradually. It gaps up. It moves in ways that shock people. Because in a tight market, there are no sellers at the current price. You have to move the price up dramatically to find someone willing to sell. This is what happened in the nickel market a few years ago. The London Metal Exchange had to halt trading because the price moved so violently that it threatened to bankrupt major participants. That was a relatively small market. Imagine what happens if something similar occurs in the gold market, which is vastly larger and more important to the global financial system. Now, I'm not saying this is going to happen tomorrow. Markets can remain irrational longer than you can remain solvent, as the saying goes. The paper market might continue to function for months or even years. But the trajectory is clear. The physical market is getting tighter. The demand from central banks shows no signs of slowing. And at some point, something has to give. When that moment comes, if you own physical gold, you're going to be very glad you do. Because the value of physical gold in your possession is going to be very different from the value of a paper claim on gold that you can't actually get delivered. This is why storage matters. This is why custody matters. This is why the difference between allocated and unallocated gold matters. If you own gold through an ETF or an unallocated account, you don't actually own specific bars of gold. You own a claim on a pool of gold, and in a crisis, that distinction becomes critical. Let me give you another historical example. In 1933, President Roosevelt signed Executive Order 6102, which required Americans to turn in their gold to the government at a fixed price. People who had gold certificates, which were paper claims on gold held by the government, had no choice. Their gold was confiscated. But people who had physical gold in their possession had options. Some complied. Some didn't. Some moved their gold overseas. The point is, physical possession gave them choices that paper claims didn't. Now, I'm not suggesting that anything like that is going to happen today. The world is very different now, but the principle remains the same. Physical possession gives you options and security that paper claims don't. And in a world where trust in institutions is declining, where faith in fiat currencies is being questioned, where the entire structure of the global monetary system is being challenged, having physical gold in your possession is more than just an investment. It's a form of insurance. It's a way of opting out of a system that might not be as stable as it appears. This is what central banks understand. This is why they're buying physical gold even at record prices. They're not trying to make a profit. They're trying to protect themselves from a system that they helped create, but no longer fully trust. And if the central banks don't trust the system, why should you? Think about what's happened over the last few years. We've seen unprecedented money printing. We've seen inflation surge to levels not seen in decades. We've seen interest rates rise dramatically, threatening to destabilize the entire financial system. We've seen bank failures, we've seen currency crises in multiple countries, and through all of this, gold has been quietly rising, not in a straight line, not without volatility, but the trend is clear. Gold is reasserting itself as the ultimate safe haven asset, as the asset you turn to when everything else seems uncertain. But here's what most people miss. The gold price you see quoted on financial news is just the beginning of the story. That price reflects the paper market. It reflects what people are willing to pay for a futures contract or an ETF share. It doesn't necessarily reflect what you'd have to pay to get physical gold delivered to your door. And that gap, that difference between paper and physical, is where the real story is unfolding. Because as that gap widens, as it becomes harder and more expensive to convert paper claims into physical metal, people are going to start questioning the value of those paper claims. This is how confidence crises begin. Slowly at first, then all at once. A few people start asking questions. A few people start demanding physical delivery. The system can handle that. But then more people start asking questions. More people start demanding delivery. And suddenly, the system is overwhelmed. We saw this in the banking system in 2008. We saw it in the European debt crisis. We've seen it play out in various markets throughout history. And the gold market, despite its size and importance, is not immune to this dynamic. In fact, the gold market might be more vulnerable than most people realize, because the entire structure of the modern gold market is built on leverage and trust. It's built on the assumption that most people will be satisfied with paper claims. It's built on the assumption that physical delivery will be the exception, not the rule. But what happens when those assumptions are challenged? What happens when physical delivery becomes the rule rather than the exception? The system would have to adapt, and that adaptation would likely involve much higher prices for physical gold, because the only way to balance supply and demand when supply is constrained is through price. The price would have to rise to a level where some holders of physical gold are willing to sell and some buyers are priced out of the market. But here's the catch. Many of the current buyers, particularly central banks, are not price sensitive. They're not buying gold to make a profit. They're buying it for strategic reasons, which means that even at much higher prices, they'll keep buying, which means the price might have to go much higher than anyone currently expects to actually balance the market. This is the change that's coming. This is what you need to prepare for if you hold physical gold. Not just higher prices, though, that's likely, but a fundamental restructuring of how the gold market operates. A shift from a paper-dominated market to a physical-dominated market. A return to gold's role as real money, not just a commodity. And if you don't hold physical gold yet, if you've been thinking about it but haven't pulled the trigger, this is your wake-up call. Because once this shift becomes obvious to everyone, once the mainstream financial media starts talking about it, it will be too late to get physical gold at anything close to current prices. The time to act is when things still seem normal. The time to prepare is before the crisis, not during it. Because during a crisis, everyone wants the same thing at the same time, and in a market with limited physical supply, that means you either pay whatever price is demanded or you don't get any at all. This is not about fear. This is about understanding how markets work. This is about recognizing patterns that have played out throughout history. This is about being prepared for a change that's already in motion, even if most people haven't noticed it yet. The central banks have noticed. The smart money has noticed. The question is, have you? Because the change is coming. The only question is whether you'll be ready for it.